The reason I'm sort of chatting today is Roger kindly sort of asked me to just have a chat about how parents and grandparents can help their children get onto the market. So basically, I'm just going to cover off about first-time buyers. And as you know, first-time buyers, it's a tricky time just to even save a deposit. And unless they stay at home and they're working, then it's pretty much, you know, a hard task to save a decent deposit to get on the market ladder. So nowadays, it's very, very common for the bank of mum and dad or even grandparents to help first-time buyers get on the market ladder. And there's a staggering 6 billion was spent by parents by gifting their funds to their children to help buy a home in 2020. So it's a massive market. And it's all about parents and grandparents just giving that helping hand to get on the market. So I'm just going to cover off ways that parents and grandparents can help. And the first thing is obviously gifting. Now, gifting is an amazing thing to do for your children, but there are risks to that as well. For example, if you have a couple, so your daughter's going out with a boyfriend and they've been together for a couple of years, they're not married, but they're ready to get onto the market. There is a risk that if you decide to gift, that at some point, not trying to be morbid or anything, but they could break up. And therefore, the gift that you gave to your daughter could be at risk, because when they sell that property, they both own that property. And therefore, your gift could be split between the ex-partner, which you might not be happy with. So what you can do is you can have what's called a deed of trust. So even though you're gifting to your daughter, you can protect the gift. And some lenders are okay with that. So you have to sign what's called a gift letter to say that you won't be asking for that money back. However, a deed of trust means, sorry, my pup. A deed of trust means that if that property was sold, then you would receive that money back. So you're protecting your daughter, you're protecting your savings, you're protecting your family really for the future of what could happen. And we never want to look on the dark side, but unfortunately in today's world, you know, partnerships do split. So that's a way that you can feel comfortable to gift and to protect your funds. Also, as a couple, if you're not married and you want to buy a property together, and you as a partner put in a bigger deposit, so say for example you're putting in 30,000 and your partner's putting in 10,000 into the property, you can have a partner agreement as well. It's a bit like a prenup. A solicitor can draw it up for you. And there's agreement to say that if that property was sold and you did separate, you would receive your share of the deposit back. It wouldn't be split 50-50 because you put more money in to start with. When parents or grandparents do gift, a lender will ask you to complete a gift letter and also provide ID and 3 months worth of bank statements. And that's to confirm that the money is actually coming from you and not from another source. And funds can come from abroad. So I had a lady whose family lived in Italy, and her parents were gifting to her. And that, again, not all lenders like it, but as long as the funds have been transferred into a UK account before application, then that is okay as well. Now, there are different types of schemes where parents and grandparents can help without gifting. So the first one's called joint mortgage sole proprietor. And what that means is that I'm a first-time buyer, I have a job, but I don't earn enough to raise the money I need for a mortgage. So what we can do is we can use mum and dad's income, or you can actually have a brother or sister or a grandparent where you can use their income to raise the funds that you need to buy that property. That's a huge positive. So for example, this week I submitted an application for a young first-time buyer. She's 20, she earns £20,000, but she was buying a property for £275,000. And we used mum and dad's income to raise the money that we needed for the mortgage. The downside of that is that the parents or whoever is helping with the mortgage, they would be liable for the mortgage payment if the first-time buyer missed a payment. So there is pros and cons to this concept, and we would say you need to seek separate legal advice regarding the commitment that you're making. But it's a great way to help a first-time buyer get on the ladder. If I was a first-time buyer, my brother said, actually, yeah, I can help you, you know, I can use your income. The downside to that is if he wants to buy a property, my mortgage that I pay is also an outgoing for him. So again, it's really important to have those conversations about what are the future plans for the person that's helping the first-time buyer, as in, are they looking to buy in the future? Are they looking to move? And ideally, the answer will be no, because it's going to cause them issues in the future. But that's a sort of a brief overview of how that concept works. Another concept is only what Barclays offers this. It's called a springboard. And this is where you've got, say, for example, as a parent, you've got £30,000 worth of savings, but you don't want to gift it because it's your hard money, but you want to help out your daughter. So what you can do is you can actually put those savings into an offset savings account, and that will be counted as a deposit. And it allows the client to have, the client doesn't have to have their own deposit. So that will be the deposit, but it's locked into a savings account for 5 years. You earn interest on it, and after 5 years, you get that money back. Now, the benefit to the first-time buyer is they haven't had to raise a deposit themselves. The benefit to the person that's helped out is they earn a little bit of interest and they get their money back. The reason it's tied in for 5 years is the theory is that in 5 years' time, the first-time buyer should be earning enough funds to take the mortgage on, and also the equity would have increased so that there's no risk regarding if that property had to be sold because the owner couldn't keep up their payments, the lender would get their money back. So that's a really good way to help your loved ones get on the market, but you're also keeping your own savings under your roof. And another thing that parents do is some parents do remortgage their own homes. They do raise money against their own property to raise a deposit, and that's still gifting. So it's a way they can do that. And also some clients own their own buy-to-lets, and so they'll raise money to gift again to their son or daughter. Regarding something I forgot to mention with the joint mortgage sole proprietor, regarding parents and grandparents helping, the term of the mortgage is based on the oldest client. So in that scenario, ideally it'd be parents rather than grandparents, but you can have young grandparents in this day and age. For first-time buyers as well, you've got the schemes. So you've got the government schemes, which is the Help to Buy scheme, where you only need a 5% deposit, and the government will give you up to 20% deposit to help you buy a new build. It's only on a new build scheme. And also you've got the shared ownership, where again, you only need a very small deposit, and that's where you part buy and part rent. So that's for clients that are on a lower income, they want to get on the market, and housing associations in sort of the new build plots, they have a few houses that are allocated. And then obviously the 90% mortgage market has come in the last month. So first time buyers now, you know, if again, they only need a 5% deposit, but again, properties are shooting down here, property prices are shooting up. So ideally, to get the better rates, to reduce the cost, they do need a bigger deposit. So that's where parents and grandparents do help out. So I'm going to try and switch screens. This one. Can you see that screen? Yeah, right, okay. So this is just a demonstration to show you what rates look like for a first-time buyer. So in this scenario, you can see here, there's a first-time buyer who's going to buy their property for £200,000. And we're looking at the 95% range. So they've got a £10,000 deposit. They're going to have their mortgage over 35 years. That's classic for a first-time buyer. And we're just looking at the 2-year range here. Now you can see here, the rates for a 5% deposit are just under 4%. And you can see here the cost is around about £800 a month. Okay, so if we actually drop that down to a 10% deposit, it'll have a little think. You can see here the number of lenders. So we've got a lot more choice. And the rate has now dropped to around about the lower 3% range. And the cost is around about the £700 mark. But ideally, you want to get down to around about a 15% deposit. And as soon as you put down a 15% deposit, you can see you're around about the 2.5% range, and your cost is around about £600. So from a spending perspective for a first-time buyer, they've got that range where it could be costing them over £800 a month, or it could cost them just over £600 a month. And they've got their other bills to pay for as well, obviously the council tax, your gas, your electric, your water, and it all adds up. So nowadays it is so important to see if grandparents or parents can help their loved ones, because it really does help them on a monthly basis from a cost perspective. And that's me. So I thought that's just a little overview of first-time buyers. I don't know if anyone's got any questions.